Hey everyone, welcome back to Corporate Decoder, where we make sense of the money world. Today we're diving into Plug Power's latest quarterly report, and let's just say they've had a very eventful quarter, almost as eventful as trying to explain their financial acrobatics. So before we get into the nitty-gritty that might make your eyes glaze over faster than a poorly made donut, make sure you're subscribed because we break down these massive financial documents so you don't have to. And hey, we have a fantastic community over on Discord to chat about all things corporate finance. Check the link in the description. Alright, let's talk about Plug Power's income statement first. For the 3 months ending June 30th of 2025, their total revenue hit around $174 million. Now comparing that to the same time last year, that's a decent jump, about 29% up. This growth seems to be driven mainly by their electrolyzer sales, which is pretty interesting considering they're in the clean energy space. Specifically, their electrolyzer sales jumped a whopping $29.8 million. That's a big deal because electrolyzers are key to producing hydrogen cleanly. They also saw a rise in their Gensure stationary power units, which are like backup power systems using fuel cells. It sounds like the demand for their core products is picking up, which is usually a good sign. However, their cost of making and selling these things also went up. For the same equipment sales, the cost of revenue was about $117 million for this quarter. That means they're spending more to make these sales, leading to a gross loss in this area. Interestingly, the gross loss percentage improved compared to last year, going from a negative 69% to a negative 18%, which is still a loss, but a much smaller one. So that's a positive trend. Now let's look at their expenses. Research and development costs were about $12 million for the quarter, a significant drop from $18.9 million the same period last year. This sounds like they're cutting back on innovation spending, which could be a strategic move, but often means less focus on future growth. Selling, general and administrative expenses, basically the costs of running the company, actually went up a bit to about $88 million. This increase was largely due to higher contract exit costs and bad debt expenses, which isn't ideal. They also spent about $3 million on restructuring costs this quarter. This is part of the plan to streamline operations and cut jobs. It shows they're trying to control costs, but restructuring always comes with upfront expenses. A big number here is impairment charges at $20.6 million this quarter, up from just $3.9 million last year. This means they're writing down the value of some of their assets because they're not worth as much as they thought. Specifically, it seems like some of their material handling investments are having problems, and they're also taking hits on their property and equipment. This is like selling a car for way less than you paid because it broke down. Then we have the loss on equity method investments, which was a painful $45.9 million this quarter. A huge chunk of that, $42.5 million, is from an impairment loss on one of their investments. This is like finding out one of your friends who owes you money is suddenly in deep financial trouble and you probably won't get your money back. Let's switch gears to the balance sheet. As of June 30th, Plug Power had about $140 million in cash and cash equivalents. That might sound like a lot, but given their losses, it's not as much as you'd hope. Their total assets are around $335 billion, but a big chunk of that is tied up in restricted $5 billion, big stuff in knowledge they can't easily use. On the liability side, they have about $152 million in accounts payable. This is what they owe to their suppliers. Their total current liabilities, or what they owe in the short term, are a hefty $835 million. That's a lot of bills to pay soon. And when you add in all their long-term debts and other obligations, their total liabilities are a massive $1.59 billion. That's a lot of IOUs. Now, here's a number that really stands out. Their accumulated deficit is $7 billion. This is the total of all the losses they've had since they started. It's like a running tab of all the money they've lost over the years. This massive accumulated deficit is why their total stockholders' equity is only about $1.76 billion, is significantly reduced by all the historical losses. Looking at the cash flow statement, it paints a grim picture of their operations. In the 6 months ending June 30, 2025, they used $27 million in cash just to run their business. That's a lot of cash burning through operations. And it doesn't stop there. They also spent almost $88 million on investing activities, mainly buying property and equipment. To keep the lights on, they brought in about $226 million from financing activities. This likely comes from selling their stock or taking on more debt. It's basically the money they needed to borrow or raise to cover their operational losses and investments. Now, let's talk about Plug Power's strategy. They're clearly in a tough spot, burning through cash and racking up losses. They're trying to fix this with the restructuring plan, cutting jobs and streamlining operations. They hope this will save them money and improve their financial health. They are also relying on future capital raises and debt agreements to keep things going. Management seems to believe they have enough cash to operate for at least the next year, thanks to these plans and potential future funding. However, they acknowledge this relies on a lot of assumptions about sales, costs, and their ability to secure more money. It's like saying you can survive the winter if you can find enough firewood and a warm place to stay without actually having it yet. Looking at the whole picture, Plug Power is in a precarious financial situation. They're growing revenue, which is good, but their costs are incredibly high, leading to massive losses and a significant cash burn. The impairment charges and losses on investments are particularly worrying, showing that some of their investments and assets have lost a lot of value. Their direction seems to be focused on clean hydrogen, which is a growing market, but they're struggling to turn that potential into profit. The reliance on multiple financing rounds and agreements with companies like Yorkville suggests they need constant external funding to stay afloat. Without a clear path to profitability, their financial model appears shaky. Scroll notable risks or opportunity tube. A major risk is their continued net loss and negative cash flow from operations. They also have a lot of debt, and if they can't generate enough cash match, added A to execute much better on their business strategy to capitalize on it. Scroll clear conclusion, Plug Power is in a tight spot. While there are signs of product demand, the company is still far from being profitable and is heavily reliant on external financing. Investors should be very cautious given the ongoing losses and significant debt load. Alright, that's our deep dive into Plug Power's latest financial saga. What's your take on their strategy and financial health? Do you think they can turn things around, or are they heading for more trouble? Let us know your thoughts in the comments below. And if you found this breakdown helpful in navigating all those corporate numbers, please give this video a thumbs up and subscribe for more. Don't forget to join our Discord community too, linked in the description. Thanks for watching, and we'll see you in the next decode.